good evening, and thank you for joining in today. Hi, Satvik. It's good to see you
Hi,
again.
Abhishek. Nice to see you again.
Likewise. Satvik, just to give you an intro to what we typically do here. Once a month or maybe twice a month, we typically engage in a webinar with our investors to give an update on what's going on in the market, specifically the unlisted segment. And since the last 2 months have been a little tumultuous, that is also something which we got questions very regularly from our investors as to what is going on in the market in general and maybe the small cap and mid cap space specifically. Um, Typically, we at Altius had also launched an AIF and PMS vertical wherein we are now moving some of our clients towards a managed structure. And we keep getting queries on how this kind of a structure allows us to better invest and do a more long-term job at managing their money. So would want to also get your insights on AIF as a structure as well. So without further ado, if Satvik, you would want to take a couple of minutes to quickly give a introduction, uh, uh, post that we can maybe just get on started with the show.
Right. So, hi everyone. I'm the founder of Generational Capital. We are a multi-family office based out of Delhi with offices in Ludhiana and Chandigarh. To give my brief background, so I started my career as a professional golfer. I represented the Indian golf team. Then I opened my own fitness startup, which was in the health tech industry. So there we got funded, then we got an exit around 2013. That's how I started my investing journey. Like as I created wealth through my own business, various other entrepreneurs were creating wealth through their other businesses, and I could not possibly be in all the businesses. So that's how my investing journey started. Did my MBA, CFA, FRM, worked in a couple of companies. Deloitte, I was part of the investment banking group. Elara India Gateway Fund, I was looking at the consumer and healthcare stocks. That was the only FI hedge fund based out of the NCR. And then at Client Associates, I was leading their equity and alternates vertical. Post that, I started Generational Capital. So we have our multi-family office. Along with that, the portfolio management service vertical started in 2020. And in March last year, we'll be completing around 1 year now. We started our category 3 alternate investment fund, essentially to capture opportunities which we could not do through the portfolio management service structure, basically.
Awesome. Perfect. So, Satvik, just to build up on this, what led you to move away from a large institution to starting your own fund? What were the key drivers behind that decision for yours?
Right. So I first of all, I always had a passion for stock picking. Like in my mind, I always wanted to either manage money for me or for the public at large. And then when I was tracking the returns of various long only portfolio managers, or you can say above average mutual funds, so I was kind of doing as better as them or much better than them. Uh, in terms of the risk also, as well as the absolute returns also. So that probably led me to start my own fund. So to answer your question.
Awesome. So, Satvik, when you started off as a PMS, right?
Right, right.
And this was in 2019.
2020. The
20,
PMS started in 2020. Yeah.
and then you ran it as a PMS for about 2.5, 3 years, and then slowly and steadily migrated to an AI structure now.
Right, right, right.
Amazing. So typically, what had been your thoughts behind starting a fund of your own? What sector did you want to look at, and why did you choose that specific sector?
Right, right. So broadly, what my analysis has been around 6-7% is the growth of the Indian GDP, and 6-7% is the inflation of the country. So approximately 12 to 14% will be the nominal GDP growth rate, which is essentially the long-term average of the Nifty and the Sensex. So the Sensex started at 100 in 1980. Today it's around 75, 76,000. So it's been like itself a multi-bagger, but broadly the Sensex doubles in every 5 years at that growth rates. Now there are some companies or industries in the country especially like now we are turning into a $4 trillion GDP. So each region, east, west, north, south, which is a $1 trillion GDP, which would be growing at multiples of the nominal GDP. By multiples, I mean 2, 3, 4x. So that is how I devised this 25 cube framework. That basically 25% sales growth, profit growth, return on equity, and ideally at less than 25 times entry valuation. So if we can get even three out of these four, then and the company executes right, so then I think serious money should be made. So broadly, there are only two ways wherewith in any stock, whether you are doing through your Altius platform in the private space or through the listed space. What is the PE ratio or the price to earning ratio we are getting in at and exiting at, and in the interim, what has been the earning growth? So basically, we try to capture both of them, getting in cheap also and identifying companies which can grow at least 3 to 5x in the next 5 years. And now coming to the sectors where we are focused on, again, it is an outcome and which might change in the future. So we had analyzed last 120 years of Dow Jones data, and we had seen that only the consumer healthcare and the IT services or technology space, they have survived all the Great Depressions, the global financial services, because either they will be catering to retail people like you and me, or they would be very, very having good unit economics, right? They would be very, very less dependent on the overall macroeconomy. Like if there is a recession or if the government is not spending, they have kind of less impact on them, and the balance sheets are also very lean. So that is how we zero down on the consumer, healthcare, and technology sectors. And mind you, these three sectors themselves have around 60 subsectors. For example, clothing will be having, suppose retail sector will be having jewelry retail. In jewelry, you will be having artificial jewelry retail, gold jewelry retail. Then there would be these bulk manufacturers who will be supplying to all these gold companies. Then you will be having footwear retail, luxury watch retail. So retail itself will be 15-20 subsectors. Our basically main criteria is to back the best executioner till they are executing flawlessly. So if the overall industry is growing at suppose 10-12%, or there is degrowth also, this company should be growing at 20-25%, that taking away market share from the competitors and scaling up very, very fast.
Awesome, brilliant. I think that answer had a lot of data, and I would like to kind of break it down from the start. So I think first thing which you highlighted was an excellent thumb rule. So you said it, you coined it like the 25 cube rule, right?
Right.
And so for our audience, breaking down the 25 cube rule, what it meant was there are 4 parameters which have to be above 25. Revenue growth, profit growth, the PE has to be lesser than 25.
And return on equity.
And return on equity has to be more than 25.
Right.
And this forms a parameter basis which we can essentially start making a short list of companies which we should focus on. Right. And I think brilliantly said that at any business, the entry price is a very crucial point, right? So typically a price is a factor of what earnings will grow by and what your price to earnings multiple will grow by. And if you can maximize both of them, then you essentially have a multi-bagger on your hands. And this formula essentially allows people to have a very quick and handy way to evaluate any company which they are hearing of. So I mean that's a very wonderful trick to have down their bellies. Second, what I really liked was the focus on the sectors, and I think sector is something which is very, very critical for people to understand, because we've seen in the last 2.5, 3 years that sometimes defense went up like crazy. It broke all records, and then suddenly things started falling, started rationalizing, and most people got stuck at a very high price. Similarly, we saw things happen similarly in the railway space. But these 3 sectors, consumption, pharma, and technology, are 3 spaces which, according to you, have been there for a very, very long time, and you foresee that they will still be dominating sectors for the next couple of decades at least. So I think that's very nice filter for people to kind of shortlist companies which they would want to invest into. Building on this, do we also look at market cap? Because a lot of fund managers kind of are either large cap driven or they are small cap driven. Some come with the assumption that only small companies can give you a 10x bagger. Large companies do not because of the scale, obviously, they cannot give you that kind of a return in a short period of time. So what are your thoughts around that?
So, frankly, we are market cap agnostic. We can, like, if the opportunity presents itself, we can even invest in a 100 crore company. And right now, like, we have been very long-term investors in now a nifty company by the name Trent also. Ultimately, so I'll give you again some data on this, because firstly, like, I always intend to be the largest investor in all my funds also. So firstly, I have to be convinced before, like, pitching it to everyone else. So around, if you look at the time when I was born, the early 90s, SAIL used to be the largest market cap company, which was a 7,000 crore company. Reliance used to be a 6,500 crore company. Today, a 6,500 crore company is a micro cap company. A 30,000 crore company will be considered a small cap company. 1 lakh crore market cap company is considered a mid cap company. So frankly, since I am not running a mutual fund, I am kind of like, running my proprietary money and giving individual investors a chance to kind of come along with me. I'll do what I think is best on a risk return perspective. So, frankly, this market cap debate does not at least make sense to me, because it's just that top 100 companies can be large cap, next 150 can be mid cap, then next 250 small cap. Out of that, and the 501 company, which is right now around a 6,000 crore company, that comes out to be a micro cap company, which in early 90s used to be the largest company. So we are market cap agnostic, and there are some sectors, like, to give an example of luxury watch retail only, I think the sector itself is a 10,000 crore sector. So how can you have a 1 lakh crore company in that sector? So even market leaders in a lot of sectors, they will be small caps or micro caps in nature. So the idea is to understand the nature of the business, the sector, and then back the best performing companies in them till they are performing the best.
Brilliant, brilliant. So I think the takeaway is, don't focus on market cap, focus on the four parameters which we just discussed, and then look at if you can back industry leaders in spaces which you like. Beyond that, it doesn't make sense to analyze whether a company is at 1,000 crore market cap or whether it is at 10,000 crore market cap, because that goalpost keeps on moving basis how the country progresses, basis how the world moves. Absolutely brilliant. Now that we are at that point, what do you see or foresee the market to be in the next couple of years, or couple of months rather? Essentially, because we've seen incessant FII selling in the last couple of months. I mean, almost 3.5, 4 lakh crore has been kind of sucked out from the Indian markets, and we've all seen companies breaking by 30, 40, 50, 60%. A lot of the people on the call would have lost a significant portion of their portfolio in the last 6, 7 months. So how do you foresee the liquidity flows changing around, and how are you as a fund manager also approaching the situation?
Yeah, so first I'll try to answer the second question first.
Sure.
So basically, this quarter which went by, the Nifty sales and profit grew by around 4% and 8%. Okay, our portfolio level statistics were 49% sales growth and 57% sales growth. So the idea is to back companies which are doing superlative sales and profit growth, and then we track this very important metric, whether they are gaining market share. Now, how we will know that is, suppose if Relaxo and a Bata are doing degrowth, and say a Red Tape, which happens to be a portfolio company, is growing 18-20%. That means it has gained basically market share over say a Relaxo and a Bata in that quarter. So basically, this is what we are tracking, and wherever the company is not doing this, so either we will plan to trim the position or exit the allocation. Now, coming to the markets overall, so frankly, I over the last 11, 12 years, wherever I have been investing, I have all made this rule that I will be 100% invested in the markets, come what may. That be it that ILFS crisis, GST implication, demonetization, what happened, then this COVID scenario happened, then this recent fall. So in our portfolio, we have been 100% always allocated, because the point is the kind of companies we are looking at. If we get them right, they can give us 10, 20, 30 times returns. So it does not make sense to be in cash. Main thing is to switch out of companies which are not doing well and get into companies which are doing well.
Wow. And I think that's a point of view which is at absolute variance to a lot of people, because the general dictum in the market is sit on cash for the next couple of months and see how the market pans out and then decide to invest.
Yeah.
So
So,
what
my
we are seeing, yeah,
question again, or you can say like my submission to that will be: suppose if like I'm running a clothing store or I'm running an electronic shop in Calcutta, suppose, right? So it's not that, say, if this Q4 is not generally not very good. So it's not that I just open my shop in Q3 for the festival sale and shut shop in Q4, that it will be weak. It is like a serious business. It is not like gambling that today we get in, we get out. It is basically ownership of a business, the stock market, which actually it is. Now, most of the investors have made it kind of a trading or a gambling kind of a situation. But I consider it as a serious business, ownership of a business. Suppose if we hold a particular number of shares of a company, so if we are not doing with our like our electronic shop or a retail shop, then why are we doing it with the stock market?
brilliant, brilliant, makes sense, makes sense. So I think our approach is to find winners wherein impact of macroeconomic cycles is least, because they are doing their business or they are running their shop much better than what others in the market are doing, and hold them out through the bad times also, because it is irrespective of whether they have taken a dip in the last 1 to 2 to 3 months, but we keep on holding everything and remain fully invested for the large part of the year. I'm saying brilliant. Brilliant. And if you could pivot to my first question, do you think that in general there is a lot of pressure on the Indian markets? Maybe not in terms of earnings pressure, but liquidity flows because of money being suddenly pulled out. And how are you approaching that? I mean, everything remaining the same, the company still doing well. If suddenly people just pull out money, wouldn't that lead to a sharp fall in share prices?
Right. So, two, three data points again on this. So, basically, the main impact, I think. So, firstly, the large caps or the Nifty stocks. So, they have kind of corrected around 12 to 15% from their peak. But if you take the top, 30 to 50 stocks out, the next 450, for which like the data is there properly, they have fallen approximately 30% from their peak. And on an average, the earning growth has been 15%. So we are talking about that, okay, over the last 5, 6 months, the stocks have become actually 40, 45% cheaper. Right. So one is this, and the other thing is like because of like running this fund, and also we talk to a lot of family offices. So most of them were running a leverage margin trading funding book, because their logic was that these top 100 stocks we will buy in the futures market, and the small cap and mid cap stocks we will buy through the cash call. Now what is happening is that margin trading, that MTF call has happened. Because of that, they have sold these positions in the mid and small cap space. By and large, that is mostly over now, because the fall has been very, very sharp. And if you see the last one, especially the last 1 week, the price movements also, the small caps companies where the numbers were good, so they have again started kind of rallying. So broadly, we had not done anything 6 months back also, not doing anything now also. Basically, wherever companies are doing well, we are holding them.
Okay. Okay. So largely the idea is that the majority of damage is already through. We're not
Right,
foreseeing any significant turmoil in the market, at least going forward. So 30,
right,
40% discount, which could have happened, has already been played out in the market. So going forward, it should be a little more smooth sailing here on onwards for
right,
investors.
right.
Makes sense. So coming to selecting stocks in such an environment, how do you kind of at this juncture go about evaluating investment opportunities, specifically because you're finding so many companies at a steep discount? Do you still evaluate them in the same parameters, the 25 cube which we had discussed earlier, or do you use something else in such times?
Yeah, so broadly, the framework remains same. So I'll just delve a bit deeper into the framework. So as of now, there are around 6,000 listed companies in the country. So we will run a simple screens or screener that, okay, over the last 5 years and 10 years, which companies have consistently grown every year, including the COVID year, at more than 20% plus year on year, right? Having 20% plus ROE. So as of date, there will be around 510 companies which classify that screener. Then I will look at that, okay, these sectors I do not understand, or probably I'm not interested in. Mostly they will be the infrastructure companies or the defense companies, uh, or public sector enterprises. Then in the three sectors which I understand, the consumer healthcare and IT services or technology, then we will do the deep dive on them. So broadly, firstly, there will be a forensic accounting framework where we spend a lot of time. Essentially, there we'll try to marry the balance sheet, P&L, and cash flow of the company, sitting on the promoter's chair and seeing that because the investor only wants to see the sales increase and the profit increase. He is not concerned about other parameters, but that is where the company will fudge its accounts. So normally we'll see cash conversion should be very good, cash flow from operation should be very good, receivable should be under control. If there is more than 6 months receivable, there should be write off. If there is 800 crore cash on the books, there should be at least 5-6% other income. Otherwise, it is another Satyam computers in the making. If an NBFC is there, net interest margins are very smooth. But then we see that, okay, when the profit is being transferred to the balance sheet, they are writing off the NPA through the general reserve. The one is there is a provision for tax in the P&L statement, which everyone will see. But what is the actual tax outgo from the cash flow statement? Right. So this will be on the forensic part, and then there is a 150 keyword fraud search, which we have developed in-house to again check the integrity of the promoter. So we'll go to Zoba Corp MCA site and see what are the other companies, related parties of the promoter, what are the inter-party transactions happening, whether this company which is listed that forms a significant part of the promoter's wealth, or he's just using it to siphon off money from us. Basically, then we'll go to India Kanun case mine to see what are the court cases, litigations against the promoter. If it's a labor intensive industry, we'll go to labor strat and see the lockdowns and factory strikes. Then if it's an IT services or a technology company and they are saying, okay, we'll increase 50% year on year their growth, or that is what our assumption is, we'll check the EPFO data on a monthly basis, that okay, how much is the employee count increasing. So basically, newer kind of companies require newer measures, right? So broadly, these kind of things we'll do. Then we will check with the channels, like channel checks or our the industry peers, that okay, how the company is doing, and then finally look at that what gives this company the right to win, and then make an allocation decision finally. So it is normally a 2-month process to research a company.
Brilliant. So what we follow typically is a top-down approach. We first look at our parameters, then we get a short list of companies, then we put another filter to understand the sectors which they are in. Then we do our screening in terms of growth numbers, in terms of fraud analysis, in terms of all other checks and balances that we need to do. And that gives us a list of companies that we want to then evaluate from an investing perspective.
Right.
Brilliant. Now, specifically, numbers is still something which people are able to evaluate from financial statements. But one thing which people typically struggle with is corporate governance and management integrity. So any thoughts around how people should approach that, or how do we kind of look at that space?
So broadly on the management integrity, now basically if we are willing to delve hard, everything is available online. Like everything will be available online. So like you go to basically India Kanun and you search the promoter company's name, any court case, criminal case, even murder cases, some infrastructure company promoters are happening. And then you get an idea into the lifestyle of the promoter. Suppose if it's 1,000 crore company and you see a vehicle loan on the book, the car name will be mentioned. So you'll be surprised to know a lot of them have a Rolls Royce on the balance sheet. So, these kind of things, they will give you a broad idea. And even if we are 80% correct, so then and the best part is every quarter the company comes and gives us the update and does a con call. So then we can kind of make an evaluation as to every quarter how the company is doing.
Makes sense. So what you're essentially saying is the tools are there. We just have to do the work, understand where to find the relevant data, and then analyze that to get a better assurance on the management.
Right. And otherwise, like I've seen, if the capital, so the promoter has only two jobs, basically from the profits he's generating or the cash flow he's generating. If he can generate a high return on invested capital to reinvest it back into its business, so that we can see from what is the in the cash flow from financing activities, and then from a broad understanding of the business. Or if the business does not require any capital, like say all these cigarette companies, then to pay off the dividends. Now, if the promoter is investing back at say 7, 8, 9% ROIC or if he's generating massive cash flows and cannot reinvest and not paying back dividends, that itself is basically 80% of, like, the whatever you can call it, the corporate governance or the intention of the promoter that way.
Very interesting. Makes sense. Makes sense. Now that we've discussed how to select stocks, the next question that people typically struggle is with bet sizing. So it's not about getting it right or getting it wrong. It's about how much did you get right when you were right and how much did you lose when you were wrong.
Absolutely.
Typically, आपने analysis कर ली, you found 30-40 companies which are good. Now, how do you select how much money should be deployed in each, in say terms of percentage
Correct.
of
Percentage
deployment?
I will give. So again, here also, because everything is a framework for me, because it has to be a repeatable process. So we have the 3-5-7 framework, that okay, around 2 to 3% allocation will be these, you can say, sub 1,000 crore companies, where okay, there is a 5-year track record, it is a sunrise industry, first generation promoter is there is hunger to win in a sector we understand. We know that okay, even if it becomes half, which by the way it has become like a lot of times, so then we lose 1.5% of the overall basically portfolio. But when we are right, it becomes 10, 20, 30 times, which also it has become. So then we may, like, or at a NAV level or a portfolio level, we make 30, 40, 50%. So the risk reward is 1.5%, 30, 40%. These will normally be very sub 1,500 crore companies, and then the 5% allocation will be kind of the larger companies, you can say market cap ranging between 8,000 crore to 40-50,000 crore, like the leading footwear manufacturer based out of Delhi, leading the fastest growing luggage manufacturer in the country, the fastest growing or the only watch retailer of scale in the country. These kind of companies will be around a 5% allocation. Now the 7% allocation will be companies where we know that okay, we might not make the largest money into them, but these provide the liquidity and the safety. So these will normally be companies like, say, the fastest, it's a nifty company, the fastest growing beverage manufacturer in the country. Now they are going in African countries also. So we have been long-term holders in the company. Then Trent I had mentioned earlier, these kind of companies.
Brilliant. So I
So
think
the idea is heads I win, tails I don't lose. Because broadly, if we stay in the market for 10 years, everyone will make money. Now, some will make 5 times, some will make 15 times. But broadly, point is to stay invested.
brilliant. So I think the core strategy is that protect your capital by investing in larger companies and slightly higher quantums, but also have those smaller companies with high growth rates wherein you can get a 10x, 20x bagger so that your overall portfolio can generate a meaningful return.
Right.
Brilliant. And now that we've done selection of stocks, we've done bet sizing, the last important question, which I assume most people get wrong, is exits. When should you exit? And what I've typically seen is people exiting early and not later. So the errors on the in terms of leaving out a lot of gains on the table is much higher in the investing community rather than staying put too long. So how do we look at exits? At what point, say, out of this nice short list of companies that we made and we invested into, should we kind of view an exit? And typically, what framework do we use for that?
So long term is made of a series of short terms, right? So Trent, when we invested in at around a 15,000 crore market cap, it was at around 30 times enterprise value to EBITDA. Titan used to trade at around 50-60 times. Today Trent is also at 60 times. Titan is also at 60 times. Growth rate has come down from 50% year on year to 40%. So then in these kind of situations, we will firstly trim down the position. Okay, so and then on the exit part, basically there is a basically growth rate which I have in mind. Suppose that FMCG company I mentioned to you about, that will grow at around 25%. So when I see that okay, structurally it will not grow at 25%, and probably it is at 60-70 p now, whereas I entered at around 40 p. So then it is a time to exit. So I have this framework that on a 1 year forward, if it is more than 1.5 times PEG ratio, price earning growth ratio, then most likely it is the time to exit. And I have again this framework that because money comes in on a monthly basis, for me also, for my investors also. So any company which is there, it has to double in the next 3 years in terms of share price based on my assessment of their P ratio and their earning growth rate. If the P becomes too high or the company execution becomes too low, in both scenarios, I will consider either reducing or exiting the stock.
Okay, perfect. So largely two things to monitor for investors. One, company growth rate falling below what we had initially imagined. And second, pricing going above what we are comfortable with.
Right, right. By pricing, like various, again, the P ratio is, I would say, not a very right part to it. So for various companies, it can be enterprise value to EBITDA, depending on the accounting practice. For say, some SaaS company, it can be enterprise value to operating cash flow. So that basically we have to understand from the intricacies of the business.
Absolutely. But whatever is the pricing ratio that you're using, whether it be P or EV EBITDA or price to book, when that crosses a certain threshold is what you should start trimming your position. And if that continues for a couple of quarters, that is when you should probably think about exiting it entirely. Right?
Right, right,
But that's
right.
the broad framework that we use.
Yeah.
Perfect. Makes sense. So now that we have this very clear-cut framework for the entire investment journey, could you also throw some light on one investing case study which we have done in the last 4 or 5 years? What was the triggers behind investing in that? Any company, just to help us understand a little better on how we think about investments and how does that play out in the real world?
Right, right. So again, like normal disclosures, first I'll give like, we run both PMS, AIF and this company, we are having vested interest over the last 4 years. So the company's name is Aditya Vision. It is a Bihar-based electronic retailer only. So we enter, like you have a Khosla Electronics in Calcutta, or you have Vijay Sales and Chroma. So we entered the company at around a 200 crore market cap. Right. So right from a trend at a 2 lakh crore, this company was a 200 crore market cap. But more importantly, the patterns were at play. That, okay, last 5 to 7 years, the company was consistently growing its sales. It scaled up from around 10-15 crore turnover to around a 130 crore turnover when we had entered the company. It was into the retail space, which we understood. And surprisingly, the company had had 0 store closures since it started. Right. So that is what got us interested, and it was making 40-50% return on capital employed. And one more the thing was that it had very high gross margins. So that's what was interesting in the company. So then as we delved deep into the company, broadly the analysis was till say 2015-16, 95% of Bihar did not have electricity. Right now, as we speak, 99% of Bihar has electricity. So for the first time, a lot of people were buying their TVs, washing machines, ACs. So this companies captured the whole of Bihar. Today, as we speak, it is at a 2,000 crore plus sales. And doing a run rate of around 200 crore plus, 200 crore plus of profit, if my numbers are correct. We entered at around 8-10 times enterprise value to EBITDA. Now here we got lucky, and basically today it's at around 35 times EV to EBITDA. The market cap of the company has increased from 200 crore to around 5,500 crore. This is in this fall. At peak it was around 6,500 crore. So it's been around a 25-30 bagger for us. And basically both earning growth as well as the P re-rating played out for us. And what again the minor analysis, detailed analysis which we did was why this company was doing well was because most of the other retailers, they are selling their into mobiles or the low ticket item. This company was more focused on the washing machine and the TV segment. And that has kind of a 20% gross margin, whereas these other segments have a 4-5-6% gross margin. So as of today, also in the whole of country, if you do a deep dive analysis of all the retailers, Nuvama has also come out with its report. This company has the highest gross margins and highest return on capital employed and ROE. So both capital efficiency and growth. And once it captured Bihar, it went into Jharkhand. It became the number 1 in Jharkhand. Now it is coming to UP till Prayagraj.
Brilliant. Brilliant. So I think putting this company into the same framework, the initial identification, was it through the similar screens which we discussed earlier?
Yeah.
Okay, so we got the company through the screens, then we did our own research into it. We went deeper into the business. We spoke to the management and got more insights into it. And so once we had the conviction, we set out to invest into it, right? And then over the years, because our conviction and our this thing played out in the market, also we've been able to generate a 25-30x bagger, right?
Right.
Is that how people should also approach investing overall?
So basically, research should be done before investing. Now,
Absolutely.
wherever I interact with people, research is done after investing. Like they would have heard something from probably you or me or on some TV channel, and they would have just bought kind of a token quantity. Now, the issue with that is, even if it becomes 10 times, it does not move the needle on their net worth.
Makes
So we cannot allocate big till the research is done. And if like the bandwidth is not there to research, then you can give money to people like Abhishek to manage.
brilliant. Absolutely. Very well said. Thanks, Anthik. I think broadly we've covered most of what we wanted to cover. One crucial point which we also wanted to get your insights on is typically people are still a little unaware of AIF as a structure and how does it help to invest better than what other investing mediums are. So if you could throw some light on as to why an AIF allows us to invest into the markets in a more long-term view and is structurally superior to that of the other opportunities, that would also help us get some idea.
Right. So frankly, like we evaluated all the PMS mutual fund as well as the AIF structure. So our conclusion was AIF as of today is the best structure to generate the highest risk adjusted returns. Now there are 2-3 reasons for it. Suppose if you are doing it in like an HDFC bank, Kotak bank or an ICICI bank investing, then it does not make a challenge. But if we are investing or we plan to invest in say sub 10,000 crore companies, a lot of times liquidity becomes a challenge through a PMS structure. So then what happens is, if suppose today Abhishek is giving me money, I will have to buy those limited quantities of 1 lakh, 2 lakh, 5 lakh worth of shares in Abhishek's account. But in an AIF, I could do a single bulk deal of 10 crore, 15 crore, 20 crore, and that can be sourced directly through other institutional investors. So the ease of execution is very good. One is that part. The second part is a lot of basically AIFs give the flexibility to invest pre-IPO also and an anchor investment also. Now, suppose we have done all our due diligence and we find that the company is good. So why not invest in them, say 3 months, 6 months before the IPO or at the day of the IPO rather than waiting for them to open 50%, 100% higher. Right, so that is another point of alpha generation. The third part is we can participate in preferential allotments. Although ideally, I would not like to for companies to go for preferential allotment unless they are incurring a massive capex, right? But in preferential allotments, basically some structuring of deals can also be done. Like in one pharma company, we had again been very long-term holders of the company. So there, basically, we did the structuring that the shares will be issued at a 25% discount to the current market price. It was a 110 crore round with the largest healthcare fund in the world, with Berkshire Hathaway backing them. 25% discount to the current market price with a 0.6% monthly interest also.
Wow. So I think broadly, AIF allows you to get into opportunities which are otherwise not available to retailers. Right? As an individual, I just cannot get access to an instrument which pays me a 0.6% interest and is being issued for 25% discount.
Right.
I think that is a key factor that even if we leave aside the superior stock picking, the superior understanding of the market and timing the market right, this essentially gives us an additional alpha which we are able to deliver to the investor.
Right.
Perfect. That's super helpful, Satvik. I think typically we try and keep this webinar under an hour. So I think we are at 45 minutes into the space. What we typically like to do at this point is open up the chat window and the Q&A session. And we wish to allow people to come and ask us questions and see if we can add some value to those questions. So if with your permission, if it's okay, we'll just
So I think there was one question on the chat window,
Sure.
1 minute. Do we invest in SME IPO through the QIB category? So,
Right.
so till other questions are coming in, I'll try to answer this only.
Yes.
So the as of now, the challenge with the QIB category has been that it takes normally 2 months for us to research, right? So QIB category generally opens 2 weeks, 1 week before the IPO. So we have invested in a lot of companies post that IPO once the deal came to us at that time, because we could not run screens on them because they were not listed. So it came to us only 1 week, 2 week before the IPO. So as of now, we have not done anything in the QIB category, but we'll be open to them.
Makes sense. So I think there's one more question, Satvik. Do we invest only in listed companies or in unlisted as well? If you could cover that.
So unlisted also, we have invested, and like we are expecting, like 2 companies we have invested. Both we are expecting them to IPO in the next 3 to 6 months.
Brilliant, brilliant. And I think AIF gives us the flexibility to invest into both listed and unlisted markets, right?
Right. But unlisted also, wherever we invest, we make sure that the DRHP filing has been done, so that we are not taking any liquidity risk of more than 6 to 9 months.
Makes sense. Absolutely. Great. So what we can request is, if people have any questions, they could just kindly raise their hands, and we would possibly just want them to unmute and ask the question so that we can give you an answer. Yeah. So Mr. Khoja, if you want to go ahead.
Hello, good afternoon, sir. Am I audible?
Yes, good afternoon.
Yes, sir. In nutshell, I want to understand what kind of return on investment can be envisaged by investing in AIF. CAGR, I mean.
Sure. Satvik, you want to take that?
Category 3 AIF, especially the space we are in, basically long only AIF. Like our endeavor is to kind of like do at least a 10% compounded annual return higher than the Nifty. Like that is the broad like thesis which I work with. Otherwise, the higher the returns, the better. But like basically, we have to manage the risk also. So normally, but in 5 years, basically the company's sales and profits will grow broadly 5 times. So that is what like the companies will grow at. Now, how that will translate to the share price, that is somewhat skill and somewhat luck also.
Got it. Perfect. So I think typically the target is about a 10% alpha to the benchmark, but obviously that's something we strive for, and it varies basis market conditions and basis how successful we've been in picking the opportunities.
And what I understand is it's a close-ended scheme, right? Fund.
So it's by close-ended we mean that after 1 year redemptions are allowed,
Okay.
but 1 year there is an lock-in, and that also by paying an exit load investors can redeem.
But is there any particular time horizon for the scheme, say 5 years or so?
Yeah, it's a 5 + 1 + 1.
All right. Okay. So what I understand is, then what way it should be considered better as compared to the corporate deposits, which are offering 11 to 13% of return.
Corporate.
So it's not very clear, sir. If you could just rephrase your question.
Yeah. So I'm asking, of course, this is an instrument which carries risk, and it offers 10% kind of return. So what way it should be considered better? Sorry?
I meant 10% higher than the Nifty. So Nifty long-term average is 30%.
Okay. You mean to say that it will outperform Nifty by 10%, right? Okay.
And again, one more thing, the corporate deposit will give you simple interest, that also pre-tax, right? Here
we are talking about CAGR.
Here we are talking about compound interest post-tax. So around 26% compound interest, 10 years is 10 times money, like 1 crore becoming 10 crore. In a corporate deposit, 10% interest is basically 1 crore becoming 2 crore post-tax. Out of that, you remove pre-tax, you remove 30% of that, it is 1.7 crore in 10 years.
Right, sir. And what is the ticket size for this AIF? May I know?
So AIF, the SEBI classification is a 1 crore minimum ticket size.
All right. Okay. Thank you, sir.
Thank you. Vikas ji, how are you? If you want to go ahead with your question, please.
Hello, can you hear me?
Yeah, sir, you're audible.
Yeah,
Please go
no,
ahead.
Abhishek ji, I just wanting to know that what are the chances of listing of unlisted NSE shares currently? Because you are in touch and you have a fair idea, so it would be good for us to understand.
Right. So I think, sir, on NSE, I'll quickly cover, but I've done that in the past. But typically, they are waiting for the SEBI okay to launch an IPO. So because it's a registered MII, a market intermediary institution, they have to take a SEBI approval before they launch an IPO. They have received clearances for all of the previous troubles which they had from Supreme Court. So now there is no outstanding legal issue per se, but they still need a SEBI okay before they launch it. That is being expected in the next quarter or so. So overall, the IPO timeline seemed like a 12 to 15 month period.
I see. Okay, okay. Thank you. Thanks.
Right.
And I do not know whether it is in a right forum or not, but can you also give us an idea that which company in the unlisted zone may be then good to invest in at this juncture?
Sir, I think the current webinar we wanted to keep a little focused on.
Okay.
Yeah, and I think I'll speak to you on call personally, sir, for this.
Okay, fine. No, I'm sorry if
No
I
worries, no
did
worries.
ask another question. I'm sorry, I was not knowing about it. I'm
No
sorry
problem,
for
no
that. Okay, then. Thank you very much.
So I think there's a question on chat. Give me suggestions on a data center company and also give a good name if possible. Is it possible for us to do that?
So,
Or if you can help understand the theme a little better, that should also be okay. From Mr. Jayesh Vora.
okay. So, data center, basically a quasi data center, like we had been very long-term investors in a company called E2E Networks. So they had listed at around a 200 crore market cap in 2018-19. Today they are at around, I think, some 5-6 thousand crores of market cap. So they had been Bloom Ventures back. Today L&T has taken a 20% stake in them in over the last 3-4 months. So the stock price is down around 40% from the peak in like this correction which has happened. But in the data center theme broadly, that is the only company we are holding, because first generation promoter is there. The management pedigree and the quality of investors was very good, and the kind of work they were doing, that was pretty impressive. Like around 15% of India's unicorns had been built up on their platform.
Wow, brilliant. Makes sense. Thank you. Mr. Selva Kumar, if you would want to quickly unmute and ask the question.
Yeah, regarding Polymatech, right? What is the update? Anything?
Sir, again, this webinar is broadly for the AIF and a general understanding of how we are picking stocks. With respect to purely unlisted companies, we can connect separately over the call. Mr. Arun, if you want to go ahead.
Hello. Yeah, Arun here. Thank you for the webinar. Can you please provide some guidelines on how to choose a particular AIF and what are the things that a retail investor should look at?
Absolutely. I think very relevant questions, Atul. I think what are the parameters? I'm also curious.
Exactly.
Right. So firstly, AIFs are divided into three categories: category 1, 2, and 3. Right. So one will be mostly be VC funds. So there I like what I generally try with my money. It should be institutionally backed and having a proven track record. Category 2 are like very, very diversified, like real estate funds also, credit funds also, and private equity funds also. So again, private equity funds again should be like the likes of multiple Bloom, Chirate, so on and so forth. And credit fund should again be like strong institution, because this is where basically getting the money back is required. So like ICICI is doing very good work there. Then in the category 3 AIFs, there are two kind of AIFs. One is the long short category. So in the long short, broadly, it's a 35,000 crore market. There are around 25 funds active in the space. But because it is a very specialized category involving the work of derivatives, so it requires a lot of skills, because in listed, if we are wrong, we can get out also. But in derivatives, losses can be very, very high. So there again, we like prefer fund managers which are having a very long term track record. Like this particular fund, it is a Mumbai based fund by the name ITI Long Short Fund. So like we really like that fund. So they had been positive in the COVID, they had been almost positive in the global financial crisis, also down only 1%. When the Nifty was down 28%, mid and small cap was down 40%, they were positive in that time frame. So the idea is like what a long shot to do, that fund has been doing. Uh, and then coming to the main category where like we operate in, which is the long only category 3 alternate investment fund. So here normally what my suggestion or like how I analyze is, they should be founder led funds, right? Because basically the founders all skin in the game will be there. Firstly, that is there, and the founder should be a stock picker. It's not that he should be a business or a CEO kind of a guy, and the stock picking should be done by someone else, and there should be a decent track record of the founder creating wealth for himself. Because unless he has made money for himself, how will he make money for his investors?
Very true. I think lovely explanation, Satvik. Just to add on to this, what might be helpful is to first understand the risk and length of investments in each of the AI. So CAT 1 typically has a very long life. So you typically need to be ready to invest for at least 7 to 10 years, because the companies are small, the companies are in their startup phase. We don't know how much time they will take to kind of get into a serious place of business wherein they are potential listing candidates. CAT 2 is typically where you invest into private companies but slightly more mature companies. And CAT 3, like Satvik covered, was wherein you can either look at derivative based funds which give you returns irrespective of market conditions, or long only funds which are investing largely into the listed space. So I mean, first evaluate from a risk return and timeline perspective, and then boil down to the parameters which Satvik talked about. This might be a sensible way to look at it. Satvik, one interesting question I think from Mr. Varun Gupta. Hi Satvik, we've heard about the winners. Can you also tell something about our losers and what went wrong there?
Right. So normally wherever we have gone wrong, it's basically the kind of growth we had expected that did not come through, and we were not agile enough to sell early. That is broadly like this recent visual effects company where we are holding like decent quantities or percentage of the company. So we are expecting them to grow 50%, 60% plus year on year. And the thesis was where the Indian IT was in the early 90s, Indian VFX or the visual effects industry is there today, because the VFX companies are sitting in Chennai and Bangalore, and they are doing the VFX work for like your Spider-Man, Avatar, all the Hollywood movies. What earlier used to be done by Disney and Pixar. So we really liked that space, and it was a very high cash generating business because of people services business, Indian cost and dollar revenues. But then the Hollywood writer strike came in, and that 50-60% growth obviously did not happen. It went into a degrowth only. So the market was factoring in 30-40p. Now all the companies, the overall sector has only come down to around 10 times P, and the earning growth has not coming in. So we exited the companies at around 30-40% kind of a loss. But what saved us was they were like a 2-3% kind of a allocation. So we lost only like 1.2% of the NAV. So the point is to lose less and win big. Like if we are able to manage that, then I think we'll be able to sustain over a very, very long term.
Brilliant, makes absolute sense. So I think largely
this is on where we lost capital. But one more important part is where we basically where we lost the time value of money. Like this leading NBFC, which is a Nifty company. So we were invested in 2020. Since 2000 company, the Pune-based leading NBFC, but the stock price did nothing for 4 years. The sales and profits tripled in that time frame, but they were doing their incremental business as declining return on equity. So that is also like a loss only, because we did not make any money for 4 years. We could do anything with that money.
absolutely. So I think largely where our thesis did not play out because of other macroeconomic factors, or the growth actually played out, but market did not give it the valuation for some reason which is unknown to us. So I think
we got in only at a higher valuation. Like we were wrong in our entry valuation. So broadly, if you are right, 50% of the times also, I'm very happy that way.
Brilliant. Makes sense. Perfect. Let's take a couple of questions there again from the people raising their hands. Mr. Vikas, if you want to go ahead.
Yeah, hi Satvik. Hi Abhishek. Very good evening.
Good evening.
Go ahead.
Yeah, so my question is typically, are we investing in Indian scripts or we are also investing in scripts listed abroad, for example, Nasdaq listed stocks? Number one. And number two, we are seeing that we are achieving growth more than the Nifty, let's say 26% CAGR. So what is the exact CAGR in this AIF as of now? Two.
Right.
And third question, I'm sorry, third question. If let's say we have a listed company in this AIF, so whether the bonus stocks or let's say right shares, so whether the benefit is passed on or typically the AIF return will get credited to the investor. That are the three questions.
Right.
Sure.
Right. So on the first question, so like because SEBI as of now does not allow us, like, because we have not taken a GIFT City registration, it is a normal domestic registration to invest into international stocks. So we are only doing domestic only, and in domestic also there are so many opportunities that frankly I do not feel the need to look abroad also. Like all my personal wealth is also invested into Indian businesses only. So one part is that. The second part on the track record. So we launched in March last year the alternate investment fund. Till a couple of months back, we were outright the number one alternate investment fund as per PMS Bazaar and Money Control and your PMS AIF World and all. Uh, After this fall, we are up around 29% in this financial year. And the mid cap is broadly 2-3% up. The Nifty is up 5-7%, and the BSE 500 is up around 5-6%. So there has been around
That's
a
great.
20 odd percent alpha over like across any benchmark you take.
That's great. Yeah. And third is bonus and this right shares.
Yeah. So all that is added to the NAV. Basically, it is added to your return.
Okay, cool. Thanks, sir.
Brilliant. Mr. Srinath, if you want to unmute and ask.
Yeah, sure. Hi, guys. I have a very simple question. How is it different from PMS in terms of ticket size? And also, you may have partially answered the question, but I would still like to ask because I jotted down the question. In terms of returns, in percentage terms, how better is AIF in compared to PMS? Thanks.
Ticket size PMS is 50 lakh, AIF is 1 crore as per SEBI, the minimum ticket size. Now, like various then fund houses do like larger, like Carnelian is doing a 3 crore AIF size. So it depends then on the fund to fund. On the second slide, so basically, like this is my you can say assumption or like being in the industry and managing public money, that given the same fund manager of PMS and an AIF, he will generate higher return than the AIF if he is into the right kind of deal sourcing. By that I mean like developing his network of investment bankers, like-minded fund managers, and being very active in research in the pre-IPO market. And then second is the execution also. So this in the same stocks, the fund manager will make higher returns than an AIF versus a PMS. This is what like my thesis is.
Okay, thank you.
Brilliant. Makes sense. So a couple of questions on the chat on the AIF structuring.
So Abhishek, just one more thing. Basically, like we are running both the PMS and the AIF. PMS, we are not accepting new money. So from this calendar year, the PMS is up around 18%. AIF is up 29%. And both I am the fund manager only. They are 90% exact same stocks, because the 10% unlisted, they are to valued at cost only. Because whenever the IPO comes, so that will be there. If you remove that 10%, it will actually be 30% on the listed universe in the exact same stocks in the PMS and AIF.
I think basically what we covered, AIF is actually a superior structure than PMS if the ticket size is not a problem for an investor, because it allows you to get deal flow which otherwise a PMS cannot invest into, essentially.
Right.
Brilliant. So two quick questions which we have on the AIF bit, and then we'll probably wrap up the interview. But the first is, what is the duration, amount, and frequency of contribution to the current fund?
So we take full 100% contribution upfront, which is 1 crore minimum. Then the top-ups can be done. So we have an SIP mode also. In fact, like we would probably be one of the only fund AIFs in the country having a single day 100% digital onboarding. Everything done through the Jam Trinity and Aadhaar. right? And after that 1 crore investment has been done, weekly SIP can also be set up in multiples of 1 lakh. And whenever the investor wants to do a contribution additional in multiple of 1 lakh, that can be done.
Understood. Brilliant. And Mr. Prasanna, had any past AIF already launched? I think this is our first one, right? So I think
This AIF is the first one.
I think that answers that. I think on the chat we've broadly covered everything. I think we've just one last hand raise, if you don't mind, Satvik.
Right.
Mr. Ahuja, if you want to kindly go ahead.
Yeah, my question is, what are the charges and how do they compare with the industry charges for your AIF?
Perfect. And thank you, sir, for covering that. I think I missed that. I should have already asked that. But yeah, please, Satvik, if you could throw some light.
Right. So on the charges side also, we have tried to keep it like, very competitive, and basically when we make returns, we are earning. So on the like more than 5 crore kind of investment, it is 1% fixed fee and 10% profit share over 10%. Normally the industry structure in the P space is a 220 space. So if that answers your question.
So you said only if it is more than 5 crores. What if somebody invests 1 crore?
1 crore, it is 1.5% fixed and 10% profit share over 10%.
Okay, I got it. Thank you.
Perfect. I think this is super interesting. Thank you for sharing. Yeah. So, Mr. Rajan Patel, I think let's make yours the last question. I think you've put something on the chat as well, if you would want to ask your question.
It's just that do you invest in does the AIF invest in startups also?
If no, so like I would avoid that as of now, because generally I would not want to take that liquidity risk of more than 1.5 years. As such. And like startup also, like I would call these SME companies also as kind of quasi startups also, because here we are getting the best of both worlds. We are getting a startup kind of growth also, and we are getting the liquidity of the stock market also. It's just that we need to marry the two and get the right opportunities where we are making multifold returns. So I play that startup game through here. So I'll like give you a couple of examples also. So there is you can say the monopoly in dental e-commerce. Basically, there are around 3 lakh dentists in the country. Around 1.5 lakh dentists are buying their all the equipments and their consumables through this platform. So this is, if you were talking about 5-6 years back, this company would be probably a Sequoia funded or a multiple funded. But today it is listed on the SME exchange. It is doing a 70-80% return on capital employed and growing at 50-60% year on year. Then there is a drone e-commerce company, which is again doing around a 70% return on capital employed, growing 50% plus year on year. And all are doing like, more than 150-200 crore top line. And growing at 40-50% plus year on year. So these kind of companies, if they had to raise funds 5 years back, they would go to these PVC funds, but today they are listed on the SME space.
Makes sense.
So I think largely the ecosystem has shifted. What earlier used to go, deal flow used to go to larger funds, is now available to invest for us via the SME platform. And I think that's a lovely shift which has happened in the last 2-3 years.
So one fact is also there that the SME IPO index, it went from 100 to 1 lakh today in the last 12 years. But most of the investors, including me, have missed the rally because everyone is saying it is a fraud, it is a fraud. But around 1,200 companies have been listed on the SME space. Out of that, 400 plus have gone to the main board. It is essentially a 200 crore company going to more than 2,000 crore company. So the risk reward is very favorable. It's just that we have to remove the fraud companies and invest in the genuine companies there and manage the portfolio weight. Then I think serious money should be made. And till now also a lot of institutions are not very keen, probably because the check sizes there are very small. But it is fine for us. Like we are not an ICICI or a Kotak, so it works for us.
Actually, I mean, size is always an advantage. The smaller size is always an advantage for a fund manager.
Right.
Once you become too large, a lot of opportunities become out of your reach just because you have to deploy so much capital into one opportunity.
Right.
Perfect. One last question, Sarthik. This has been asked twice or thrice on the chat from Mr. Neeraj. which are the 2 unlisted companies that you have invested in?
So name, probably I would not like to disclose, but one is in the dairy sector, right? So the whole, and I'll give you a broad framework for it, right? So the whole industry in the dairy sector is kind of at a 30-35 time price to earning multiple, be it in Hudson Agro or Dodla Dairy, and they are mostly regional players. Now, this company is doing well in its region in MP, and we are getting the company at around a 9-time price to earning ratio. The industry average return on equity is around 5, 6, 7%. This company is doing 35% ROE. So getting the company at 9-time P at a 35% ROE, and mind you, this company is making good cash flow from operations also. So cash conversion is around 80%, which is kind of unheard in the dairy industry, and it is pivoting to the D2C segment. So all your milk basket, Milky Mist and all are getting insane valuations in the private market, right? So I think this company should do well. And we have gotten cheap, so it has all the triggers of that 9p going to 30p, and the earnings doubling in the next year.
Beautiful. Perfect. I think thank you, Satwik, for taking out the time. This was a super insightful session. I think we've covered a lot of ground. So right from the entire framework which you kind of use to select a company, size your bet, get the right entry point, get a right exit point. I think if executed well, this can be a real game changer in way people are managing their portfolios. And I think people also got a very good sense of how AIFs can help them build long-term wealth, and specifics into that. Obviously, we can take up on our one-to-one calls. But I thank you for taking out the time and helping us navigate, especially the last 3 months, which have been very tumultuous for all investors. Thank you once again.
Thank you, everyone.
Perfect. And thank you everyone for joining in. This was a new series which we started in terms of our webinar efforts. Typically, we used to cover unlisted companies, but we'll be having a bunch of ideas to kind of work on things which help us understand macroeconomic events, help us putting up frameworks on how to make investments which make us meaningful money. And while doing all of that, we also remain a lot at peace with ourselves. So I think that is going to be the 3 pillars on which we will be doing more webinars in the future. If you have anything which has not been answered, please get in touch with any of your RM, or just drop in a mail to our company ID, and we will absolutely reach out to Satwik and get you answers on that. No problem. Right. Thank you, everyone. Have a great weekend. Thanks, Satwik. Thank you, everyone, for joining in. Take care.